Hey, Archie, do you think I might be lending money without knowing it and not be getting paid a market rate of interest?
Well, Rob, you might be. So we should definitely dive into that. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, certified financial planning professionals, Archie Hoxton and Rob Hoxton. And today, we're talking about lending your money for no interest when you don't even realize you're doing it. And so this is possible, and people do it all the time. And some of these you'll have heard of before.
Can I paint the picture?
Yeah.
So, Archie, I'm picturing it this way. You lend money to Uncle Charlie, and you think you're going to get paid back with interest, and you don't get paid back with interest, and you don't even get paid back. Is that what you're talking about?
Yes, but you didn't know you were lending to Uncle Charlie. You add that in, and then you get...
So he borrowed it from me without telling me, with no intention of paying interest or principal back.
Pretty much.
Okay.
Yeah.
Yeah.
Sort of. It's not perfectly like that in every scenario, but it's really important to know about this because, if it is Uncle Charlie, maybe you loan money to Uncle Charlie and not expecting to be paid in interest, or maybe not even expecting to be paid back. But if you're lending to, say, the government or a big institution or a bank, you probably expect to get paid interest for it because, particularly with a bank, they're going to expect that you pay interest if they loan you money. So I think that this episode hopefully will be enlightening and just we want to emphasize the importance of knowing who when you're lending and getting paid a market rate for it.
There's some stories about some new class action lawsuits that are coming up on this particular topic because it's become obvious, I guess, that this is happening. And just for the record, neither of us have an Uncle Charlie, so that was a made up name. His name is actually Uncle Richard. No, just kidding. There's no Uncle Richard either, actually. So,
well, there might be an Uncle Sam.
The Uncle Sam. Yeah, that's right. Yeah, he does. He does tend to take loans and never pay you back. Anyway.
So, well, let's start with that because that's the one that I think most people know about. It's when you may unintentionally lend money to Uncle Sam and not get paid interest, and that's getting a tax refund. So you file your taxes. A lot of people think about their tax refund kind of like a little spring bonus. You file your taxes. You've been withholding all throughout the year. The time comes, you look at your bank account, boom, you've got a little tax refund in there, and it feels good. It's like, yeah. However, you've lent your money to the government, right? You overpaid.
Yeah.
And now they're paying you back, but they're not paying you interest for the right to use your money throughout the year.
Let's break it down. So let's say you pay it, but you're giving them too much money. You're withholding too much, or you're doing too much in quarterly estimateds throughout the year. And let's say you overpay taxes by $10,000. And I'm just using that number because it's all zeros and it's easy to do the math. If you could have earned 5% interest, which is about the average probably of what you could have gotten in a money market fund or in a CD or a high yield savings account, that probably would have cost you anywhere from, $200 to $350 or so in lost interest. So yeah, it is nice to have the windfall in April or in March or February, whenever you file your taxes. But it is expensive money. You are giving up a lot.
Yeah. Yeah. And there is sort of a psychological side of this, I think, where people get that sort of benefit. It's almost like mandatory saving, where it's kind of like with your 401k. It doesn't hit your bank account. You don't see it. The difference is in your 401k, you're earning interest and probably capital appreciation on your investments, and you're benefiting from that, that withholding. With tax withholding, it doesn't work that way. So maybe the thing to do is adjust your withholding or adjust your quarterly estimateds and try to get a little closer, and then increase your 401k contribution so that you get the same benefit of I'm putting money away. I never even see it hit my bank account. I'm not tempted to spend it. I'm required to save that. I can't pull it back out. And then, don't lend so much to the government every year. And then in April, just look at how great your 401k balance is doing and say, there's my bonus. Right? I saved more for myself.
Hopefully,
more.
Yeah. Hopefully, yeah. And it makes me think of a really great sort of small business idea. If I could get people to give me their money to hold for 6 months, and if they don't expect me to pay them interest, they just want me to give the money back to them after 6 months. Now that is a business model that would work, right?
Right.
Because I could invest it, collect the interest, and not, you know what I mean? I mean, it's just bad business personally, not to get paid a market rate on your money. And that's an example of one that a lot of people are falling victim to.
Yeah. Yeah. Another one, and this is a big one that I think this one goes under the radar a little bit more than a tax refund is checking accounts. Keeping too much money in a checking account, right? So you're lending your money to the bank. In this case, with a checking account, you have a deposit. The bank can go and lend that money, and they lend it at interest. And that's how the bank makes money. They lend out the deposits that you
and a lot of personal and certainly a lot of business checking accounts don't pay interest.
Yeah. And so if you have a really big balance in those accounts, that's money that you could be earning interest on because you're lending it to them to use and not earning interest. However, they offer accounts that pay interest. Right?
You just have to ask for it.
You have to ask for it. They're not going to, I mean, if they can take your money and not pay you any interest and earn interest on it, and you're okay with that, then, I mean, they're not going to go tell you, hey, we want to pay you more interest. You got to go ask about their CDs, ask about their high yield savings accounts. If they don't have it, yeah, maybe it's time to shop around a little bit. I mean, in this case, the market can determine whether or not they're competitive enough with their savings rates. And if enough people say, hey, you know what, that's not cutting it for us, and go somewhere else, then, that they'll have to offer a better, more competitive rate. So, but yeah, that's another really obvious one that is a great example. Just move it to a new account, maybe at the same institution, and lend your money at interest.
And Archie, that's really the people who make that mistake they're just not paying close enough attention, right? So, and it may be that they have a large checking account balance just for a short period of time, and otherwise have a fairly small balance and appreciate the convenience of not having to worry about where their money is and what the interest rate that they're earning is. But you got to be aware of it. Got to be on top of things and not just sort of going through the paces financially in life. You got to be aware of it.
Yeah. If you're giving someone the benefit of using your money, you should be compensated for that. Again, unless it's like a family or friend situation, but you're giving someone the use of your money. You have the right to be compensated for that. It's just up to you. Another big one, this was in the news recently, is gift cards. So there are companies who, and some of them, gift cards are a big part of their business model. And so they have these gigantic pools of money. We're talking billions with a B of money on gift cards that this company has, that much of which has probably been forgotten about. It was loaded onto a gift card and the gift card got lost or whatever it is, or an account got, forgotten about. So they've got all this money in gift cards, knowing that some of it is going to be redeemed for, the goods that company is offering. But some of it isn't ever going to be redeemed.
Yeah, I mean, here's a great example of it. It might even be the same company you're referring to, but we have this little service promise at Hoxton Planning and Management that we promise to respond to our clients' inquiries, whether they be calls or emails, same day. And if we fall short, which we do from time to time, it's coffee on us. So we send a coffee, from a popular brand, a coffee gift card, a $10 gift card, which will get you basically one really fancy coffee if you want that. And we send it to them with a note saying, we're sorry we didn't get back to you as quickly as we had promised. Here's coffee on us. And it's really, people just appreciate it because it's, we can't make guarantees in the line of work that we do, but we can guarantee you that we'll either call you back the same day or we're going to give you a gift card. And I know a lot of those gift cards don't get used. I don't know for sure, but I can imagine how that would be the case.
Yeah.
And so that money just sits on that company's balance sheet forever.
Yeah, and they can just put it into treasuries, earn, 5% on, billions, and that's a lot of money. Or they can take that money and invest it into future business projects, new assets, whatever it is, R&D, and earn a return in that way through their business.
So there's got to be a better way to handle the gift cards. We don't really want the merchant to be artificially enriched by what we're trying to do. So what do you think?
Yeah, I mean, and on one hand, gift cards are a great way to sort of like lock in a future purchase with a company. And of course, like giving a gift. Everybody's gotten a gift card as a gift. One really great way to do this is if you're buying a gift card or doing an online gift card for some sort of loyalty points, just preload right before you go and buy, right? That way it doesn't get forgotten about. You're not giving use of your funds to the company for an indefinite period of time.
So you're in the parking lot, you're going to use a gift card in order to get those airline miles. You're in the parking lot, you go ahead and buy the airline the gift card through the airline for the airline miles and walk in and do your purchase.
Yeah, that's a good way to do it. So you're getting whatever the loyalty rewards are for that company through using the gift card.
But you're holding on to your money and earning interest as long as possible.
Right.
Okay.
Right.
Yeah.
Another way is if you're giving it as a gift, a big part of this is just knowing that you're lending your money effectively to a company, whether you end up benefiting from it or not, and they will benefit. They'll get to use those funds for whatever they decide they want to use them on, whether the product actually ends up in the hands of the person you're giving the gift card to. So if you understand that and you're okay with that, I think that's fine.
Well, and once you give the card, it's really them lending the money to the merchant, right?
Right.
Yeah.
Right.
Okay.
You've given them. Yeah. So, it's not like we're, saying gift cards are a bad thing. They're a fine thing.
They're a tool like any other.
It's important to just know that. And if that bothers you, there's other ways to do it. You can just give cash, for example. Everybody loves cash.
Hey, before we run out of time, it would be good to touch on some of the stuff we're seeing in the press about organizations and sweep accounts and that sort of stuff. Can you touch on that?
Yeah. So up to this point, things that we've talked about are pretty, above the table. It's like, hey, your checking account isn't paying interest, and they're upfront about that.
There's nothing sneaky. Nothing sneaky there.
That's upfront.
Yeah.
Nothing sneaky. This is where we get into some of the sort of the sneaky gray area where companies are getting in trouble. And in short, what's been going on is very, very big investment companies, when interest rates went up, they put their idle client funds allegedly into sweep funds that don't pay a whole lot in interest. Meanwhile, those companies are earning interest on those funds. Part of the problem is how clearly was this disclosed to people? Is it truly fair and in the best interest of the depositors? And even sometimes using customer deposits as a bargaining chip in big business negotiations, which, is pretty unsavory for, I would say, most of the typical consumers.
Yeah, I mean, it just has a real odor to it. And it seems like that's the sort of thing that your customers should know. If you're using their money and you're paying them less than market rates and doing it in such a way that it enriches you without them knowing, if that's what's happened, I don't know if that's what's happened.
Yeah.
That's pretty crummy. That has a real sort of slimy feel to it.
Right. Yeah. And so I think that it's really important to understand what you're earning and understand what you could be earning and what a market rate is and what the trade-offs are. Right. So a sweep fund is convenient. You can get money in and out really quickly. If you wanted to invest in a money market mutual fund, it takes an extra day. You probably earn more though. So this is all about being aware and understanding what you can and ought to be earning for giving the use of your funds to another, particularly in a big institution, and what you actually are earning from them. And if it doesn't pass the sniff check, if it's like, I'm sacrificing 3.5% of what I could earn just for liquidity, I don't know if that makes much sense. So it's all about being aware and informed and knowing when you're lending money out and when you ought to be compensated for that.
Yeah.
So anyway, I think that pretty much covers everything we wanted to talk about today. So we hope you enjoyed it. Remember to like, subscribe, hit the bell for notifications, leave us a comment if you have any questions, or reach out to us. Hit the number on the screen, shoot us a text, or give us a call. We'd love to hear from you. Anyway, we will look forward to seeing you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.